Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Thursday, January 22, 2015. You're looking at a daily chart of the SPY. And you're looking at an ECB that came through with flying colors today. So they did exactly what they set out to do. They threw some numbers out to the market earlier in the week. I think it was yesterday. And they said they were going to do 50 billion of bond purchases per month, and that was what they floated out to the market. What they came out with today may have been slightly better than that. I don't know the exact numbers, but all we know is the market had a positive reaction, and we had a pretty darn good day to the upside, and a lot of stocks performed today. A lot of markets were strong today. A lot of sectors were strong. IWM, the small cap index was strong. Everything was strong today. Now, what you need to know is that cycles matter. And last week when I was telling you the market's due to bottom, and we did bottom, and now we've been up for several days in a row, that's not the ECB causing the market to go up. It's the cycle causing the market to go up. And what happens is if you flip this chart over, if you just took a mirror image of it, and if we were going down this week, if the market was due to top last week, if everything was exactly the opposite, and we were going down this week, today, after the same announcement, today would have been the same day, but on the downside. Okay, it would have been the same energy pulling the market down as the same energy pulled the market higher today to the same magnitude. And that's the power of these cycles. Okay, so where do we go from here? Well, I think there's some more upside, but I do, and I've been telling you this all week long, that there's a cycle turn between today and tomorrow. Now, it's always plus or minus one day, and because we've been up all week long into this cycle, the probabilities are now in our favor that the market's going to decline only on a daily chart, right? So what that means is that it's a short-term daily cycle. And what that means is you could see, let's call it a 2 to 4 or 5 day on the outside pullback before the market resumes higher. Because last week, and I know this can get confusing, but you can watch this over and over again. Last week, the bottom that we put in should be a multi-week rally in the stock market. So the short-term cycle may be a 2 or 3 day pullback, and where would we go if that does occur? Okay, well, we'll probably retrace about 50 to 75% of this move from down here to up wherever we finish here, okay? And where I think we're going to finish is somewhere in the neighborhood of this pivot high, which is 206.88. We'll probably get to 207. Okay, so look for the 207 plus or minus 25 cents, give or take. Okay, and that's where I think this market should top out. If it's going to do it, it'll do it tomorrow. Okay, and then I don't know that we'll reverse tomorrow, but maybe Monday. That would be the plus one day. Okay, and if we started down next week, you could look for half to 3/4 of this move. Okay. From down here to wherever we finish. So where we would wind up is about the 201 to 202 area. Okay, maybe 200.50 up to, let's call it 201.5, in that neighborhood. We don't have to worry about that now. Maybe even this pivot high at closer to 202. That's a likely stopping point. If we go a little bit lower, you're down here at $200.55 or 50 cents. Okay, but we don't have to worry about that until we start to see how the market's handling any correction that might occur. Might is the operative word. Could we continue higher and make new highs? Absolutely. Absolutely could happen. But right now, the way I calculate the markets, the probabilities are in the favor of the market making a turn either tomorrow or on Monday or early next week. And then we should see, 2 to 4 days of downside, something in the neighborhood of 50 to 75% of the correction from this bottom up to wherever we finish this high. That's going to put us somewhere in this neighborhood here. Okay, and then from there we could proceed higher. Okay, high, down, or up, down, up, down, up, down, up. So anything's possible, okay? This market's been choppy all year since we turned right in the beginning of January, down, up, and I'm looking for another down right now, but I'm not looking for all that much, so be careful on the downside. But if you are short the market or you went short today, you can probably hold on, and if you saw a daily close solidly above 107, you have to assume I'm wrong, and the market's probably going to continue higher up to these highs here. So consider a daily close above 207 your stop out point if you're short right now or will get short tomorrow. So it's a pretty good risk reward from here. I think that's not bad. If we at least go up a little bit tomorrow, you can pick up a short anywhere in this area and just keep it on a daily close above this high here at 206.88. I'm going to call it around 207 or higher a close. You got to get out. 206.88 is the actual number. Close above 206.88, you're out. Okay. I talked about the IWM being stronger. We don't need to go in more detail. It was just strong, and that's that divergence that we talked about the last couple of days went away. That's why all I did was mention it the last couple of days that the IWM was diverging from the S&P, but it made up for lost ground today, and there's no harm, no foul. So everything looks good. The trend line held that we had drew in here for a few days. We basically, the market repelled off that trend line, went higher. So all in all, we're reading it pretty good. Just stay with me and we'll navigate you through the markets. Crude oil, nothing new there. We're still trying to find a bottom. There's no bottom to be had. I mean, I'll bring up the USO chart, but there's nothing going on. It's just nothing. We're just chopping around. We're just sideways, up, down, 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 up, down. There's no rhyme or reason for any pattern that's developing here. There is no pattern developing. It's actually bearish, if anything at all. You're below all these moving averages. I mean, the market is just as weak as could be. So anytime the traders want to push the market downward, it's pretty easy to do because anybody that's long the market is going to is probably going to get scared away if the market starts down again. So they don't want to experience another $5 swing in the price of crude oil. All right, that's enough on that. It's going nowhere right now. We just have nothing going on. Gold pretty much did exactly what we said it would do. And now we're fluttering around the highs, and we'll see if the gold pulls back at all. I think we should pull back from here, but any pullback, in my mind, is going to be about $50 in the price of gold. That's going to equal down to this 200-period moving average, maybe this pivot high from over here, okay, at $20.50, let's call it. In that neighborhood, this gap window, $20 and 34 cents. So anywhere in this area is really good stopping point for a pullback. There's a lot of support. You have the 200-period moving average, you have a pivot high, and you have a gap window. If you see gold come into here after a multi-day decline, okay, say by mid to late next week, this would be a good buy area for gold, for GLD, because there's a lot of chart support in this area here. And on that note, folks, I think I'm going to... Oh, and by the way, if gold continues higher, you're looking at this double top here at almost, let's call it 127. So if there is upside to GLD right now, it's to 127. I just don't see... The risk-reward is not in your favor of being long right now, but could it go higher? Sure, it could. But the risk-reward is actually for a pullback right now, so that's where we are. All right. I'm David Frost, MyStrategicForecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.